Hey guys, what's up? Alec back with the daily stock market, and look at that. We have a crazy green day today. Shopify's up 13%, Neo's up 12%, Moderna's up 12%, Coinbase up 11%, Square up 10%, Upwork is up 9%, XPEV up 10%, Snapchat up 9%, and the list goes on and on and on. Almost every stock is up nearly 5 to 10% today, which is a great sign for this market. So in this video, let's go over some FANG stocks and some technology stocks that I think are some great buys right now. Jumping right into the video, I think Facebook, aka Meta Platforms, is a great place to be buying. They're up 4% on the day. However, in the past month, they're still down 16%. And if you guys remember a few months back, they took a spill. They're still down 38%. So now they're seeing a little bit of rebound coming. We really want to see them above $200 per share and closer to like that $210, $215 mark to see an upward recovery starting to form. I think Facebook will definitely recover. For a long-term stock, a big tech, FANG stock, mega cap company, I think that this is one of the best deals out currently, under $200 per share. Every small business, if you guys know a small business owner, there's a good chance they're advertising on Facebook and Instagram. And if you guys don't know a small business owner, there's a good chance that you know someone who uses Facebook or Instagram or WhatsApp on a daily basis. Their PE ratio is one of the smallest, the lowest out of the FANG stocks or big tech stocks, and that's a great sign to see a low PE ratio, implying that it's a good idea. So anything below 20 PE ratio is really good. We have Facebook at a 13 PE ratio, implying it's a steal. You see a 52-week high of $384, so it has large upside potential, almost like a 75% upside potential to all-time highs. I think they'll hit new all-time highs in the next 12 to 24 months for sure. The market cap is also one of the smaller ones on the list out of the big tech FANG stocks as well. Now, Google is one of the next stocks that we're going to be talking about in this video. They're a great advertising play as well. So I found an article that actually compares both Facebook and Google, so I thought it would be good to delve into. So you'll see, even though the competition is intensifying, Meta Platforms and Google currently still dominate digital advertising. Both are good candidates to play unstoppable secular trends of digital advertising. Recent correction provide entry opportunities for both. This article provides an in-depth comparison so you can pick one that suits your risk and your time frame. All right, Meta is more like a startup compared to Google, though an extremely well-funded one. Both Facebook and Google are good candidates to tap into the unstoppable trend of digital advertising. Investors should not be too alarmed by the competition, especially not by the quarter-to-quarter fluctuations in their active users and margins. All the major players are competing for the digital ad pie, and the good news is that the pie is getting bigger at the same time. This year will mark a major milestone in the world for advertising. For the first time, digital ad spend in the US will exceed traditional ad spend. All right, that's huge. All right, according to eMarket's latest forecast, by 23, digital will surpass 2/3 of total media spending. Furthermore, both Facebook and Google are renovating and evolving relentlessly. At the same time, they are both shoring up their moat in the digital ad space, and also at the same time developing other products to diversify their revenue source. So that just proves that Facebook and Google are going to remain dominant throughout the year if digital advertising is just going to continue to around 60% or even 75% of all of the advertising going on in the US. Although Facebook and Google do provide different growth scenarios, safety, and risk versus reward profiles, there is no bad choice here, but potential investors do need to understand the differences and pick one that suits their individual risk profile and time frame. Facebook is more like a startup compared to Google, though an extremely well-funded one. It spends more aggressively on research and development and seeks more high-risk, high-return innovations. As you will see, it has more aggressive risk versus reward profile than Google does. Google's more of like a safer stock, and it invests in futuristic technologies under the metaverse themes such as augmented reality and virtual reality. Facebook These new technologies, if successful, can generate major impacts on wide range of addressable markets beyond the digital ad spend, which would be the metaverse. Both feature a healthy total return in the long term in the double digits range. 14% projected for Facebook, 9% projected for Google. Right out the gate, Facebook is one of my favorite one on this list. They're one of my favorite stocks in the whole stock market right now, under $200 per share. I think it's a great place to be holding for 2 or 3 years or even 5 years down the road. That's what I'm personally doing, holding 2 years minimum, and a lot of my shares I'm holding for at least 5 years minimum on top of that. Now, they are going to be providing more reward scenario than something like Google, but they'll also be providing more risk scenario than something like Google. So Google being our next stock on the list, up 5% on the day. However, in the last 3 months, they're down 9%. Not nearly as much as Facebook's 33%. All right, so they're a little bit lower, and they're not even close to a 52-week low. I think personally they could get a little bit lower. We could probably see Google closer to like $2,400, $2,300 per share, and that's when I'll start being a lot more interested in something like Google. All right, you can see I only have a little bit of Google. The PE ratio is 22, so it's not under that 20 PE ratio mark. Remember, the PE ratio on Facebook is only 13, implying that it is a better deal. You'll also see the market cap is almost a $2 trillion company, where, Facebook, on the other hand, is like a third or even a quarter of the size as something like Google, which implies that there's more room to grow and they could have some more extreme growth over the next 2 to 3 years compared to something like Google. Now, Amazon's the next one I want to talk about, and I like them a little bit better than I like Google right now, okay, personally. Now, they're down 9% in the past week. That's a huge, huge downward movement for Amazon to be moving down almost 10% in just 1 week. They're down 20% in the past 3 months. And as you can see, they're at a 52-week low. So unlike Google, right now they are at a 52-week low. And they also are actually at almost a 2-year low. All right. So they really haven't been this low since, what was it, like June of 2020. They consolidated for an extremely long time. I went over this in one of my last videos. Whenever Amazon starts consolidating for approximately 2 years, you always see a breakout. Like right here, we saw the breakout following, and we saw a consolidation back here, and then we saw this breakout right here after this 2-year consolidation that was down here. All right, so if history repeats itself, Amazon could be consolidating for 2 years. It's at basically a 2-year low right now, which it's very rare to see Amazon at a 2-year low. So right now I'm taking advantage of that. I'm buying Amazon pretty heavily right now. Anything under $3,000 I'm scooping up, but I'm buying heavier. I think that we can see Amazon go closer to like 24, 2,500. And if we see them closer to like 2,200, that's probably when I'll start buying a whole share at that point. Now, we haven't talked about Apple in a while, so let's see what's going on with them. They're up 3% on the day today, and in the past month, they're down 5%. They're also at a 3-month low. Well, they were just yesterday. We're at a 3-month low of $157 per share. And in the last year, they honestly have that 52-week low of closer to $120 per share. If you also draw the support and resistances, you can kind of see that it looks like it's going to be bouncing off the support right now, and it can definitely be going up to that resistance. So here you see it hitting the support, and it definitely could be bouncing up to that resistance there. For any shorter term traders, that could be a good option play up to around $170, $175 on Apple. It's a little bit risky though because it's already starting to bounce, but that could also be good because it's showing some upward momentum and a reversal coming. So if we look at the market cap and the PE ratio and the 52-week low, what we'll discover is that Facebook is like a fifth of the size of Apple, so it has a lot of growing to do. And keep in mind, if Facebook starts selling their metaverse headsets like crazy, like how Apple sells iPhones, that could be another lucrative income revenue source for Facebook. Now, Apple has a PE ratio of 26. I personally want to see that PE ratio lower, probably closer to 25 or 20. However, Apple's an extreme growth company, so sometimes a higher PE ratio is justified when you're looking at something like Apple. If we look at what analysts have to say about Apple in the next 12 months, you'll see that they have them pegged at around an 18% upside on average, and some analysts have them as high as $215 per share in the next 12 months. Okay, if we scroll down and see where these analysts are coming from, you see a bunch of five-star analysts: Morgan Stanley, JPM, Bank of America Securities, all above $200 per share, and they just reiterated this price point for the next 12 months. They just reiterated it yesterday. So that's always a good thing. A lot of five-star analysts coming in, and as soon as we see a three-star analyst, those are the ones that are rating below $200. So most of the five-star analysts are actually rating Apple above $200 in the next 12 months, which I can agree with. So personally, I think that we will see Apple at new all-time highs in the next 12 months, close to that $200 per share, just like the analysts are suggesting. Now, analysts just had their event, and here's why Apple analysts are bullish over the peak performance event. So here you'll see Apple announced a few breakthrough products at its spring launch event dubbed Peak Performance, held on Tuesday, which was yesterday. Here are all the sell side reactions to the announcement. The Apple analyst Morgan Stanley maintained an overweight rating of $210 per share. Apple product announcements are a testament to the unmatched output of its 26 billion plus research and development engine. The company has successfully brought 5G capabilities to sub $500 iPhone price points, ported the M1 SoC to an additional iPad model, and announced an in-house SoC named M1 Ultra for the new Mac Studio, the analyst wrote. The iPhone SE3 likely to present upside risk to the iPhone estimates for 2022, the analyst said. Apple marked the first real expansion into live sports with the announcement Friday night Major League Baseball games begin added to Apple TV Plus. Key software takeaways: the addition to 2 exclusive Major League Baseball games to Apple TV Plus suggests that the company could be following Amazon, all right, in their prime, Amazon Prime, okay. Apple's decision to add exclusive sports rights to its streaming service puts Netflix at a disadvantage, the analyst indicated. Apple, the analyst said, could emerge the winner of the streaming wars due to its abundant free cash flow, captive iOS audience, and its willingness to follow clever strategies. So that is a good transition into Netflix. That was up around 6% earlier in the day, now up 5%. There's still about 15 minutes left before the stock market closes. And in the past 3 months, we see Netflix destroyed, down 43%. It was closer to $630 per share just 3 months ago, which was not long ago at all. Okay, so the question is Netflix a good time to buy if it's basically in 2018, it's the same price it was today? So it's close to a 3-year low. This is one of the stocks on this list in this video out of the FANG stocks that has been hit the hardest, other than Facebook. And you can see that the market cap is definitely the smallest at only $159 billion market cap. So if something like, Apple or Amazon decides to take over that space, they have more cash flow than the entire worth of the company, of the market cap. Apple has so much cash on their balance sheet, they could probably even buy Netflix if they wanted to. However, I doubt Netflix would sell for under $300 billion, just because, they're at a low point right now, so they probably don't view their business, Netflix business, as a $150 billion business. They probably view it as twice that, so they probably wouldn't sell for $150 billion, even if Apple offered it in cash. So that is a good thing to kind of consider. The PE ratio is a little bit higher than the other ones as well. So personally, I would stay away from Netflix. You can see I only have $317 in Netflix myself. But I think for someone that's trying to diversify a little bit, it could be a good one to look into. The risk versus reward scenario is a little bit more attractive, and it's probably the most attractive than it has been in the last almost 5 years, because even in 2017, Netflix definitely wasn't the same name it is today. It's grown tremendously from since then. It's put out great movies, great TV shows, and the subscription users have greatly increased since 2018, 2017, and also the price of the subscription has greatly increased since then as well. So here we can see the bottom line, the net income since 2017 has increased significantly every single year. What other company do you know that is increasing their net income by 241%, and the next year 85%, the next year 47%, the next year 53%, the next year 81% growth from 600 million in income? This is straight income, straight profit, to all the way up to 4.8 billion in net income, and their price is the same it was in 2017, 2018. Today, right now, you can buy it for as much as, remember when it was getting 600 million and 1 billion in net income? It's the same price it was today. Now, if we look at total revenue, same story. All right, so 32% growth, 35% growth, 27% growth, 24% growth, 18% growth. No other normal companies are growing like this, double-digit growth, and they're such a high company, over $150 billion, to continue to grow revenues like that. They haven't even missed a step, that not even an off year at all on their net income or their total revenue. It's just continuing to grow, and for the next 5 years, will probably continue to grow as well. So with that being said, they could be a good idea to pick up some. It's a growth story company. The price is as low as it was in 2018 when they were doing a fraction of the revenue and they were doing a fraction of the income. They were doing like 25% of the income that they are today, yet their share price is the same price it is today. So this stock market obviously doesn't make sense right now, just because they're not growing at such a rapid pace. They're not growing their net income by 50, 60% per year. That doesn't mean that the share price should be brought all the way down to 2018 levels. Okay, so I think if we see Netflix under $300 per share, I'm going to be forced to pick up around $2,000 worth of Netflix. It's just going to be too good of a deal to be passing up. If Netflix goes below $300 per share, that's my price point to basically go crazy on Netflix. But me going crazy means that I'm going to be holding for 2 to 5 years. So if you buy under $300 per share, just know that this is a long-term hold. And if we kind of look at the support and resistance as well on something like a Netflix, you can kind of see that it is close. It's actually under that resistance right now. So you can see it's peaking below currently, and there is a good chance that it can pop up significantly. So you can see the resistance is very high. So I think we'll see a lot of people making money in Amazon and Netflix. I think if you buy at $300 or under $300 per share, there's a great chance that you can sell for 100% gain around $600 per share in the next 2 to 3 years. And if you tell any investor that they can get 100% gain in 2 to 3 years, they would be more than happy to invest in that company. So obviously there is no guarantees, but I think it is a strong probability. I think Netflix is at a great price right now, and if it gets closer to $300 per share, I definitely personally won't be passing them up. Will you? Comment below. Hope you guys like this video. Share this video with a friend if you think they'll find it helpful. Now is a great time to be buying stocks, by the way. So if you want to get on my close friends list, go ahead and check out the success number 4 on the highlight section of my story. Success number 3, there's success number 2. There's over 400 positive testimonials on my highlight section of my Instagram now. So looking forward to making 2022 our year. And there is money to be made in the stock market. If you look at anyone who's successful in the stock market, they typically buy during the dip. They don't sit on the sidelines with their hands in their pocket when the stocks are at these great valuations. We forgot to go over Microsoft, but maybe we'll go over them in the next video. Leave a subscribe if you guys haven't already. If you got this far in the video, definitely subscribe. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.